Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at 3 stocks from the broader tech industry that investors might want to consider buying and holding on to for an extended period of time. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. All right, so we're about 2 weeks out from the election, and there's still hope that a second stimulus bill gets done, perhaps before the November 3rd election. But we're not really going to spend much time on a market recap today because it's sort of been the same story as for the last couple months. The market's chopping around, still up big from its March 23 lows and up so far in 2020 as well. So instead, we're going to take a look at 3 highly ranked stocks from the broader tech sector that longer-term investors might want to consider buying despite any near-term setbacks or pullbacks in the market, depending on what happens over the next few weeks in terms of the election and the second stimulus bill, and then perhaps the virus as well. So we're going to start with Square, which trades under the ticker SQ. The company topped our Q2 results back in August after the Fintech firm posted blowout quarterly results overall that had Wall Street really salivating. So we're going to quickly just recap the company, and then we'll dive into its most recent quarter and then take a look ahead at what to expect from their third quarter results. So Square, its portfolio has expanded far beyond its original smartphone and tablet connected credit card readers, those small little white square devices that were originally aimed sort of the very small, even micro-sized businesses or street vendors to be able to take credit cards. Today, the company's portfolio includes a broader range of those point-of-sale devices, as well as debit cards, small business loans, peer-to-peer payments, buy Bitcoin, and more than that. The company's Cash App, which is that peer-to-peer payment app, now competes directly against PayPal's Venmo and traditional banking giants such as JP Morgan Chase in the booming peer-to-peer payment space that's only going to expand for years and years to come. So with that said, Square's clients, non-consumer clients, often include smaller businesses. So this is restaurants, bars, coffee shops, smaller brick and mortar businesses, things like that. Obviously, they have been negatively impacted by the coronavirus. Despite that, the company still posted 44% sales growth in the first quarter, which topped estimates. And it's also staying in line with growth from other recent periods. So despite some setbacks on smaller brick and mortar businesses, especially ones that involve people being inside spaces such as restaurant and bars, were impacted obviously greatly during the first quarter. Despite that, they still posted 44% sales growth. Then in the second quarter, Square's revenue soared 64%, which marked its strongest growth as a public company. This impressive growth came despite the fact that in the second quarter, its gross payment volume actually dropped 15% from a year earlier. So with that said, the strength really came from huge growth in the Cash App, which is that peer-to-peer payment app we mentioned as well. So it's now become more of a digital wallet for consumers. This is where Wall Street hopes the company can continue to grow for years and years. So that Cash App profit was up 167%. And then by July, the company noted that Cash's gross profit was up around 200% from a year earlier. The Cash App was boosted by a big surge in direct deposits. Some of this is coming from stimulus checks. So consumers had over $1.7 billion in their accounts in the Cash App, with Square at the end of the second quarter up 86% from the first quarter. This was also accompanied by a big boost in spending on Square's debit cards, which they obviously generate revenue from as well. And more than double the number of customers a year earlier are using those cards. So over 7 million were using those cards in June. Overall, Wall Street was really happy to see that consumers are using the company more for its banking style features, which is a big reason why this could be a longer term play. And it's also part of the reason why it continues to go after becoming getting actual banking charter. And the hope is that people who started using some of these features during the pandemic will stay and continue to spend money on their cards, continue to direct deposit checks. You can also even invest in stocks, buy Bitcoin, all of those more traditional banking features, financial services firms for consumers, not just merchants and taking percentages of payments that merchants are scooping up. So on top of that, we should note that its sellers business saw its volumes return to year-over-year growth in July, and its online gross payment volume was up 50% from a year earlier to make up about 25% of overall seller volume in the second quarter. So obviously it saw a big growth in that online payment volume, which is going to be huge going forward as more and more of these small businesses do everything they can to boost their e-commerce sales. So all of this helped the company's overall gross profit grow by about 30% last quarter. And as we mentioned, and this is going to be really their continued pitch to Wall Street, the company's ability to provide these key financial services both to merchants and consumers, especially during these tough times, has helped the stock outperform, and investors hope and are betting that this will translate to continued longer-term success. So overall, SQ stock has climbed about 205% in 2020. This crushes PayPal, which is its big rival. That 90% growth crushes Amazon, crushes the broader tech market's 30% climb. And this includes a 50% jump in the last 3 months. The stock was up around 2% in morning trading on Monday at around $190 per share. So just below its recent highs. And despite its big climb and trading right near its highs, SQ is trading below its own year-long highs in terms of forward 12-month sales. It's trading at 9.4 times forward 12-month sales. This is below its own 1-year highs of 11.3, so trading at a discount to itself, which is always a good sign, despite trading at new highs in terms of its actual stock price. And this is also not too far above the industry's average of about 7.3, and it trades at a discount, once again, to PayPal, which is trading at about 10 times forward sales. We also see that fellow pandemic high flyer and outperformer Zoom is trading all the way at 53 times forward 12-month sales. So that helps put into perspective of SQ's valuation. So it's trading at a discount to its own 12-month highs, a big discount compared to Zoom, and it's trading at a discount compared to PayPal, and not too far above its industry's average, even though it's trading at near its all-time highs in terms of its actual price. And now we're going to go ahead and take a look at what to expect from the company's results in the third quarter and going forward. So right now, our Zacks estimates are calling for the company to post 64% revenue growth again in the third quarter, so matching its big performance from last period. And then we're calling for another 63% growth in the fourth quarter as well, to help bring its full year fiscal 2020 growth up to 54%, jumping from under $5 billion in the year ago period all the way up to $7.3 billion in 2020. And then we're calling for another 27% growth next year as well, above this year's 54% growth on the top line. That said, the company is expected to see its adjusted earnings slip a little bit on the year. Slip 35% this year from 80 cents per share in the year ago period to 52 cents per share. That said, the company did crush our bottom line estimate last quarter, so we could see better results on the bottom line. But people in Wall Street seem to be a little more focused on that continued top line expansion. And then if we look ahead to fiscal 2021, we're calling for a big jump back. We're calling for 121% growth from our current year estimate of 52 cents per share all the way up to $1.15 per share. So expected to bounce back in a big way next year. And then in terms of putting that revenue growth into perspective, this year's 54% growth we're calling for would easily top last year's 43% growth, fiscal 2018's 49% growth. And then if we look ahead to next year's growth would roughly match what the company did in FY17. So some solid top line growth that compares favorably to what they've done in recent periods. And then on top of that, the company has seen some impressive bottom line estimate revisions over the last 90 days. So up big from right before it reported its last results. This helps it earn a Zacks rank number one, a strong buy at the moment. So overall, investors might want to take a chance on Square as a longer term play in this fintech space for its ability to become more of a broad financial services player, helping both consumers and merchants. And in this quickly changing world, Square does seem like it's going to be able to have the ability to become something more of a futuristic bank in the near term future. With that in mind, Square is set to release its third quarter 2020 results on November 5th. So maybe people want to wait to see what management has to say and what the guidance is and any updates in just several weeks. But as we said, longer term investors don't need to necessarily worry about timing the market precisely. So if you're interested in Square, you might want to consider it as a longer term investment. But it doesn't hurt necessarily to wait a couple weeks to see how their actual results and guidance comes in. And now we're going to move on to another stock in this broader tech space, and that is Intuit, which trades under the ticker INTU. Intuit is part of the ever-growing cloud-based software as a service industry. The pandemic has continued to highlight how vital these software firms have become to businesses, big and small, and it also proves that these services have become so valuable to, as we mentioned, companies of all shapes and sizes, and even individuals, that it's hard to go back because so much of what you're doing on a daily basis or quarterly basis is tied to these softwares. So Intuit itself offers a variety of financial services, and it's arguably most famous for its online tax software, which is TurboTax. So that service alone is great since, everyone knows the saying, taxes are unlikely to be going out of style anytime soon. The company also offers software geared towards accounting, small business money management, and personal finance. This includes QuickBooks and Mint, so it's expanding its financial services offerings. The company boasts roughly 50 million customers globally, and it's seen its annual revenue grow by between 11% and 16% over the last 5 years, so some solid and stable top-line growth. The company topped our Q4 FY20 estimates in late August, with full year 2020 revenue up about 13%. Zacks estimates call for the company's fiscal 2021 revenue, so its current year, to jump about 7.4% and then come in another 11.3% higher next year to about $9.2 billion. Meanwhile, we're calling for its adjusted revenue to climb by 9% this year and then another 14% next year. And like with Square, the company's bottom line earnings revision activity helps it grab a Zacks rank number one strong buy at the moment. And then in terms of stock price performance, the company has popped about 30% in 2020 and 130% over the last 3 years. This blows by its software as a service markets 55%. And then if we look over the last 5 years, the company has nearly doubled its industry's average, up 260%. And at the moment, its dividend yield roughly matches the 10-year U.S. Treasury. And in the end, investors might want to consider the company for its tax-focused offerings that, as we mentioned, aren't likely to go out of style, and for its ability to expand its portfolio of financial services that should help it continue to grow in our world that becomes really ever more digitalized by the day. And now we're going to close out with another big cloud-based software as a service stock, arguably the largest of these stocks, and that is Salesforce, which trades under the ticker CRM. Salesforce's cloud-based customer relationship management services, so that's that CRM, offers clients a range of tools and applications that help its customers run everything from sales and e-commerce to marketing and analytics. The company's subscription-based offerings were already becoming widely popular for years and years and years, even basically the last decade plus. as more businesses of all shapes and sizes jump into this cloud-based software market. Then, like with a lot of these companies, the pandemic forced a big remote work push, and it highlighted the strength of Salesforce and other cloud software companies. And it really showcases the ability of its business model to grow during these tough times, and then the ability for it to grow continually as our world becomes ever more focused on computers. So we should also note that Salesforce is one of the newest DAO members. That happened with Apple's stock split shakeup. So it's now a part of that 30 stock index in the cloud software powerhouse. Saw its stock price soar after it blew away estimates in late August. Its revenue climbed about 29%, with its adjusted earnings up 120%. So with that in mind, looking ahead, our Zacks estimates are calling for its full year revenue, which is FY21 for it this year, to climb about 22% to nearly $21 billion, with it then expected to climb another 17.5% in FY 2022. We should also note that its adjusted earnings are expected to jump about 35%, and its revisions have climbed positively since its last report and recently as well, to help it land, like all of the three stocks we're talking about today, a Zacks rank number one, a strong buy at the moment. The stock is up about 60% in 2020 to more than double its industry's average. This trend continues over the last 5 years as well, with Salesforce shares up about 250% compared to its software services market's 116% climb. Despite this overall strength, the stock rests about 8% off its early September highs, and it's currently trading at a slight discount compared to Microsoft in terms of forward sales, as it has for much of the last 2 years. So just putting into perspective and valuation, because some investors might assume that Microsoft is trading at a big discount compared to a company that's doing more growth like Salesforce is at the moment. So overall, with all of these stocks, it appears that their business model is going to be solid and growing for years and years and years to come. And the pandemic has just highlighted Salesforce's strength. But like all these stocks, you don't need to time the market as well. Obviously, things can change in the next several weeks, so you might be a little more cautious about diving in if you're concerned of things taking a pullback on the election. But as I mentioned again and again, if you're a longer term investor, you have a year plus horizon, it might not be a bad idea to consider buying some of these solid and stable tech stocks that have a futuristic looking outlook in terms of different business models. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.